The stock market is a roller coaster right now. Prices are dropping, portfolios are bleeding red, and investor morale is hitting rock bottom. But believe it or not, it's precisely in these moments that the biggest opportunities are born. A crisis doesn't just test your nerves, it can actually supercharge your returns in the long run. In this video, we'll dive into how crises really impact your portfolio, how long these downturns usually last, and why younger investors, in particular, should see a market crash as a massive long-term advantage. So stick around if you want to learn how to turn market setbacks into powerful return boosters. If you're invested right now, you're probably not having the best time looking at your portfolio. Since the start of the year, stock prices have taken a significant hit, and it doesn't look like a V-shaped recovery is just around the corner. But here's the thing. Anyone investing for the long haul has to expect these turbulent phases, and it's not nearly as bad as it might feel. In fact, it can be a decisive advantage. As the finance expert Gerd Karma once said, young people should almost hope for a stock market crisis because it works in their favor over time. Sounds crazy, right? Let's break it down, step by step, to understand why a crisis isn't the end of the world. Let's look at the long-term performance of the stock market. Take the MSCI World Index, which tracks stocks from major developed countries. Since 1977, this index has grown by an average of 10.2% per year, including reinvested dividends. 10.2% a year sounds incredible, but that's only half the story. That number covers over 40 years, which included amazing bull runs and brutal crashes. Not a single year delivered exactly that average. Some were way higher, and others were deep in the red. Now, let's look at a more recent period, from 1998 to mid-2022. Over these 25 years, the MSCI World delivered an average annual return of 6.7%. Still a solid figure, especially when you consider that after inflation, this was about a 5.1% real return. But here's the crucial point. Those 6.7% are just an average. No investor ever got exactly 6.7% each year. In reality, the annual results swung wildly. So, what does that mean in practice? Between 1998 and 2022, there were years when the MSCI World delivered returns over 20%, a true party for investors. But there were also 7 losing years, some with double-digit losses, and that's the point. Stock market returns don't move in a straight line. They come in waves, sometimes surging up, sometimes crashing down. Beginners who see 6.7% annual return often imagine their money growing steadily, like interest in a savings account. But the stock market just doesn't work that way. In the short term, it's unpredictable, almost random. But over the long term, it follows a clear upward trend. A great book on this is A Random Walk Down Wall Street, which explains why short-term market moves seem random, but a reliable growth pattern emerges over long periods. Now, for the exciting part, how do crises actually affect your wealth if you invest regularly? Let's use an example. Imagine you invested €10,000 every single year since 1998 into the MSCI World. But the journey to get there was anything but smooth. In years like 2001, 2002, or during the 2008 financial crisis, your entire portfolio would have been in the red. In 2008, for instance, your portfolio's value would have plunged from around €160,000 to just under €100,000. Seeing that much red is psychologically tough. But here's the hidden advantage. You kept investing your €10,000 every year, but you were buying at much, much cheaper prices. And those low entry points boosted your long-term returns for years to come. Let's revisit the 2008 financial crisis. The MSCI World fell about 40%. A portfolio worth €160,000 suddenly shrank to under €100,000. A shock for any investor. But now, imagine that crash didn't happen in 2008, but right at the very beginning of your investing journey in year one. Your first €10,000 would have instantly dropped to €6,000. Painful, for sure. But you would have kept investing every year after that. The result: instead of €673,000, your portfolio would have grown to €948,000. Why? Because for almost your entire savings period, you were buying at much cheaper prices. You would have built up about €275,000 more wealth, and your personal return would have jumped from 7.4% to 9.8% per year. The lesson here is that an early crash feels terrible, but in the long run, it can be a massive advantage. This example highlights a critical principle: the sequence of returns risk. The average return from 1998 to 2022 was 6.7%. We didn't change that. The only thing we changed was the order of the good and bad years. And that alone made all the difference. Depending on when those years happen, your personal outcome can be completely different. So no, it's not irrelevant when crises strike, especially if you're investing through a regular savings plan. Now, let's flip the scenario. Imagine the best stock market years came first, and the bad ones only hit toward the end of your investing journey. Your portfolio would look like an investor's dream at first. Within a few years, you'd be sitting on nearly €900,000. You'd feel like a market genius. But then, the bad years hit at the end and wipe out a huge chunk of your gains. In the end, you'd be left with just €246,000. Your personal return: a painful minus 0.1% per year. And that's with the exact same average annual return of 6.7%. That's the dark side. Late crises can destroy your portfolio's growth. There's one more scenario, the optimal but toughest case. Imagine all the crises happened right at the start. For 11 straight years, your portfolio would be in the red. You'd constantly wonder why you were even bothering to invest all you'd see are losses. But if you held on, the payoff would be massive. After 25 years, you wouldn't have €673,000 or €948,000. You'd have a staggering €2.5 million. Your personal return would be an incredible 16.3% per year. Mathematically, this is the best possible outcome. But psychologically, it's extremely difficult to endure. Who can stick with a plan for over a decade without ever seeing green numbers? So, what's the takeaway? The average return of 6.7% is just a theoretical number. It shows what would happen if you invested a lump sum at the very beginning. But most people invest gradually. For them, what really matters is the internal rate of return, or IRR, your personal effective return. And this is heavily influenced by the sequence of returns. That's why the timing of a crisis makes such a huge difference to your final result. So here's our first interim conclusion. Early crises are actually beneficial for long-term savers. They let you buy more shares for cheap. Late crises are far more painful, especially when your portfolio is already large and new contributions don't make much of a dent. For younger investors, this means that even if it hurts, early crashes are a gift. You buy low and reap the benefits for decades. The only downside is psychological. Watching a red portfolio for years is discouraging, and many people give up right when it would pay off the most to stay the course. To get a realistic picture, let's look at how long crises actually last. We can examine the maximum drawdown, which shows how far the market fell and how long it took to recover. Looking at the MSCI World since 1977, there have been 6 major crises that each took more than a year to get back to their previous highs. For example, during the dot-com bubble from 2000 to 2003, the market fell 48% and took 6.6 years to fully recover. The 2008 financial crisis saw a 55% drop and took 6.4 years to recover. There were also smaller crises, like the Corona crash in 2020, where prices fell 21% but recovered in just 7 months. What does this mean for you? Most crises see prices fall for about 1 to 2 years. The recovery afterward can take several years. In the worst-case scenarios, you might wait 5 to 7 years for your portfolio to hit new highs. But here's the key. That dose and tea mean your portfolio stays in the red the entire time. During the recovery phase, prices are already climbing, and the cheap shares you bought are starting to grow in value. Crises feel painful, but they are temporary. Those who stay invested are usually rewarded. So, what should you do during a crisis, and what should you absolutely avoid? First, the don'ts. 1. Don't panic sell. If you sell at the bottom, you lock in your losses and miss the recovery. 2. Don't stop your savings plans. In a crisis, you're buying at a discount. That's your advantage. And 3. Don't constantly change your strategy. If you abandon your investment philosophy in every downturn, you destroy the long-term compounding effect. Now, the do's. 1. Check your portfolio less often. It sounds simple, but it really helps you stay calm. 2. Review your asset allocation. If you realize you've invested too much in stocks for your own comfort, adjust it so you can sleep better at night. And 3. Think long term. Real wealth is built over decades, not in a few boom years. Crises are a reminder that patience is the most important virtue in investing. Let's be clear, crises are never pleasant. Without them, your portfolio would always end up larger. But when they happen, makes a huge difference. At the beginning of your investing journey, crises can actually help. Your regular contributions are still significant and can offset losses over time. It's at the end of your savings phase, when your portfolio is large, that crises cause real damage because new contributions are too small to balance the losses. This is especially critical if you're relying on that portfolio for retirement. In that case, you should gradually add safer assets to reduce volatility as you get closer to your goal. Crises are unavoidable. No one can invest for decades without experiencing down years. But they aren't the end of the world, they're part of the game. If you're young and investing regularly, crises are an opportunity. You buy cheap, and your wealth grows even stronger over the decades. The most important rule is to stay in it for the long run. Avoid panic, stick to your strategy, and don't let red numbers scare you away. In the end, patience is rewarded. You might even look back one day and say, that crisis back then was one of the best things that ever happened to my wealth. If you got value from this video, I'd really appreciate a thumbs up. And let me know in the comments how you're rehandling the market volatility and what strategy you've chosen. If you're new here, make sure to subscribe so you don't miss our future finance content. Thanks for watching, and I'll see you in the next video.